Hi, everybody, and welcome to the Digital Brands Group Investor Quarterly Webinar. My name is Hannah Laverty, and I will be introducing you to CEO Hil Davis, as well as Laura Dowling, our new CMO today. We're super excited to have you join us. We're 5 days into our webinar our live campaign, and we've done over 220,000 just with our own investor community. We're currently at $3.3 million on our Start Engine raise. And due to the popularity of the $500 credit investment, which is supposed to end today, we're extending it through the weekend. As we know, we're just getting to this call today, and we're sure you have a lot of questions. The purpose of this call today is to go through our most recent deck, but we also know that a lot of you have a lot of questions in terms of the timeline to IPO, so we would like to leave plenty of room for that. There is a Q&A box either at the top or bottom of your Zoom screen where you can use to type any questions you might have, and we will address them at the end. And from there, I will let Hil take it away.
Yes, thanks everyone for taking the time to join the call. We really appreciate it. The goal of this call is to update everyone on where we are in the process. Also, for those of you who don't know who we are, to provide that information and kind of give you the background of who we are, where we're going, and why it matters to you, most importantly, especially as an investor. Also want to update you on the path to our IPO. What are the steps? What are the timing and the likelihood of all that? And then finally, to really get you to know Laura, who we hired as our new CMO from Coach, which is a tapestry brand, which is actually, believe it or not, a conglomerate of brands as well, which Laura can touch on. And so we're really excited about since she's joined and where she's taking the brand, because we've seen drastic and very positive change since she came on board. So with that, we'll kick it off. And as Hannah said, we'd really like to take the time and make sure there's plenty of time for Q&A, because I know there are a lot of questions out there, and we've got a lot of good questions so far from people. So Q1 up to date is 2.06 million. Just to let everyone know, that's a 65% increase year over year. I know there was a thing that went out earlier. That was non-GAAP. These are GAAP revenues. So these are SEC reporting revenues. 19.5 million lifetime revenue. I think most importantly, we expect the year over year increase to be over 100% this year, especially as we go into fall, driven by new product launches. I think the most interesting thing that's when you look at the trends in Q1 is the repeat rate was really high, which is great. Number two is new product launches were very successful, which we're happy to see. And then third is the sell-through rates of all our products continue to be really strong. And we've got a much better handle now on sell-through rates by size. So our capital allocation to inventory is getting a lot tighter. So we're not wasting money on sizes that don't sell. We're only reordering into the sizes that are selling well. That hadn't been done before. So that is really going to help the cash management and also generate higher revenue. Also, what's really interesting is, and Laura can speak to this, we changed some of our marketing philosophies in terms of cost per customer, how we look at that. And it's really opened up the top of the funnel, but it has actually generated the same return rate. So the nice thing is we've really opened it up and drove a lot more customers into the brand, but it's not costing us any more per customer. We're getting the same return as we were before because we just have a much more sophisticated way to look at how we're approaching this. And that's really important because as those customers come through the funnel, they stay, they repeat, and that's what drives the profitability of the company. So you have to have both the new customers as well as the repeat. And Laura will talk about how she thinks about both of those and how she drives that. So with that, let's just continue down the page. So who we are, what is Digital Brands Group? A lot of you knew the company is Distilled, which was a urban lifestyle brand. And starting last year, we basically took on a much bigger approach, which is we are going to be Digital Brands Group, which is a conglomerate of multiple brands together. And the reason that is we feel like there's a couple of things that go on there. One is there is a lot of revenue opportunity with multiple brands. Most customers, in fact, probably all customers, wear multiple brands head to toe. So we want to be brand agnostic, and we think about closet share. So when you go and put your wardrobe or your outfit on that day, you're probably wearing 3, 4, 5, maybe even 7 different brands. So how can we be 3 or 4 of those? Because what we have learned, both Mark through his experience and my experience starting these companies, is no one's going to wear one brand head to toe unless you work at that brand. So don't try to fight that. Instead, create a solution, a closet solution. And that's what really Digital Brands Group does. Secondly, the cost savings is significant because we all have the same cost structure. So you're able to eliminate a lot of that. We all work on the same 1 or 2 different tech platforms. We're all using the same services. And so when you combine those into one company, there's a lot of savings. We'll talk about that, but it's really significant in terms of that. And given this, the other big thing is basically where retail's gone and where the consumer has gone, especially the millennial consumer and younger, is they want authentic brands. They want brands to be very tightly curated and have a very tight point of view. So our belief is the day of the billion-dollar brands are probably over, and you're much better off having 10 $100 million brands than $1 billion brand. The ability to build or buy 10 $100 million brands is much easier than building a $1 billion brand. And you don't run the risk of basically stretching your brand too far. So Distilled can keep a very tight brand point of view. Ace is the same way, all the brands we acquire. And having built J. Hilburn to 55 million in 6 years, I know this is incredibly achievable with the right team. And that's why Laura's here. She's the first stop of it. The second one is we're out looking for a CFO, COO. You bring them in, and then you bring in the right tech person, and you've really got an incredible team ready to go. So when you really think about our ability to build and buy 5 to 10, 50 to $100 million brands, it's really high and it's low risk. Also, I think when you look at it, then the question is, how do you make that happen? And it's about going public and being able to buy these brands with liquid stock. And what's interesting is, and we'll talk about this a little bit more, but they're willing to sell at unbelievably low multiples because they don't have an exit. We are their exit. Otherwise, they're stuck in this brand that they built. They're just tired and they're ready to basically eliminate a lot of the pain points for them. And that's really powerful because we're basically arbing. Hopefully we're trading 3, 4, 5 times revenue and we're acquiring for 1 to 1.5 times revenue. And that's really powerful. And that's how a lot of big businesses got built. Facebook with Instagram did that. There's a bunch of other big brands that have done that. LVMH is a perfect example. They went in and bought great heritage brands, paid a really low multiple for them and put them into their platform, and now they're trading 4 or 5 times revenue. We own 2 brands, as y'all know, Distilled and Ace, and then we're going to continue to add brands. In fact, we are in discussions right now and moving to term sheets on 2 different companies, and there's a 3rd one right behind it. So our plan is to make an acquisition in the next couple months. That is what we're shooting for, and we're pretty much at the term sheet part. We've verbally agreed to all the terms, and that's really powerful because now you're talking about increasing our revenue by 50% alone this year. So you're talking about a company that's probably doing 17.5 to 20 million net, which means way more gross. And so when you think about that, that's really powerful. So now you think about our valuation, you think about our net income, the valuation's really cheap because of this acquisition, because it just integrates. And in fact, it integrates so well, we're positive EBITDA next year. So we flip the EBITDA too. So you drive revenue. So when you look at next year, you're talking about basically a company that's going to do 30 to 35 million in revenue and positive EBITDA. So you're basically paying 1 times revenue right now, which is unbelievable. That's a great value. And the reason we're doing this is that we want to reward all our investors who are with us, who've helped us grow and believed in us before we list on the exchange. And when we list on the exchange, then it's going to be off to the races. And so it's basically, we're just trying to give everyone one last bite at the apple, if you will. So if you continue down the slide, what is the offering? As everyone knows, it is a preferred stock. It has downside protection. So if we were to do a down round, you would get trued up. The share price is 53 cents. The minimum investment is $500. And I think that's why we've seen such fast growth here, is that $500 is really easy to do and very compellable. As we talked about, a $35 million valuation. We have 86,000 customers. We've raised 12 million to date, of which 9 has come from the crowd. So that shows you how much the crowd has been a believer in us and why we really want to reward the crowd. And then when you look at the perks, one of the things we really wanted to do is what we've seen is when our investors are our customers, their lifetime value is super high. Because it makes sense, right? Where are you going to buy? You're going to buy in something you own stock in. That's how Nike got built. That's how Starbucks got built. That's how P.F. Chang's or all the great consumer brands got built. When you look at it, they went public very early. They're only $20, $50 million market cap companies. I know because I was part of those deals covering them in equity research. And what's amazing is it was their customers that own the stock and that drove the company to success. And that's what we're seeing as well. So what we decided to do was, how do we incentivize all investors to become customers? And so we're doing this program where it's a $500 store credit for a $500 investment. So basically, when you look at it, it's free, right? You're going to get a store credit, you're going to spend it, so now you're getting stock to go with it. And that's really compelling, and we wanted to do that because we know our ROI on that in 12 months is really high. Now that ends, I think, today. And then we might be extending it a couple of days just because this is the first time we've been able to have the webinar. So that's something that we're looking at, is doing just as a favor to our investors, because we've gotten a lot of emails over especially last night, saying, hey, I want to hear the webinar first before I invest. It's a tight time frame. So that's one of the things we're thinking about, is how to maybe extend this $500 credit a couple of days, just given the overwhelming amount of emails that we've got asked for this, just given the tight time frame, which we understand. So then after that week, it drops to 250 and then 125. So there's a real reason to kind of get in early. And again, what we see is these become great lifetime customers. So this is what the portfolio model, as an example, would look like. Going back to closet share, you've got streetwear, you've got tailored, you could have accessories, you could have women's wear, women's tailored, women's streetwear. So there's a lot of different ways we could take this. We'll start with the closet, and then over time we could expand it into the home, whether it be the bathroom, whether it be the kitchen, whether it be the linen closet. But right now we're going to focus on the closet. We want to figure out how to create outfits and curate outfits and send them to our customers very customizable. So we know that your style is tailored, or we know your style is streetwear, but it doesn't mean you won't wear a sport coat with distilled denim and then a distilled t-shirt underneath. So that's what we're really focused on, is building these style profiles. And then as a customer, you're going to get emails that have that look. And then think about how much easier it is going to buy, because you're like, wow, I like that outfit. And that's what we found at J. Hilburn. Guys buy outfits. And when you go to the store, most guys walk in and they say, yep, I want that. Just give me that. We call it the Pottery Barn effect. I'm a little bit older, so it used to be after you graduate in college, you could walk into someone's house and you'd be like, oh, that's page 17 of the Pottery Barn, because everyone wanted to basically buy what was easy. Now, women buy a little bit differently. They want to be curated too. So we think about it differently. But the thing is you can curate multiple brands, and then you create an outfit that way. And that's the power of this model, is you can literally cross-sell all these brands. And I think that's what we're really focused on. And also, we're going to wrap a loyalty program. One of the things that's been highly successful, as everyone knows, is Amazon Prime. So when you think about, the great thing about it is all these wholesale brands like VF Corp, which is a holding company, you've got PVH, you've got Tapestry, where Laura came from. If you buy a Coach, you don't get rewarded and can use those points at Kate Spade or Wiseman. Or if you buy at North Face, you can't use those at Vans or Lee's or Wrangler or Reef. But when you buy at one of our brands, you're going to be able to use the points you earned at Distilled to buy at Ace or whatever brands we have. That's really powerful. And in fact, one of the things we've been talking about is we can actually incentivize purchase in another brand by saying, hey, we know you bought Distilled. We think you'd love this piece from Ace, and we're going to give you 3x points when you buy from Ace this month. So imagine the power of being able to generate that by using a rewards-based system. And Prime has done an amazing job with that. And that's kind of how we're thinking about the world. The other thing too, I'm sorry, I just want to add, is that it also helps stabilize the revenue and the earnings. And what I mean by that is trends happen in fashion. And if you look at VF Corp, they're a perfect example. North Face for the last 3 years has really carried that brand. And they've really, if you look at their market cap and their growth, has been up and to the right. But North Face really slowed down. But what's happened is Vans now is red hot. So while North Face is slowing, Vans is ripping, and the stock continues to go up because they just don't have exposure. If they were just North Face, their stock would do this. But because you have a portfolio, you're going to have a better chance of doing this versus the volatility as you're tied to fashion. And that's really important here. When you look about the shared services, we kind of talked about the marketing and being able to cross-market. As an example, when we launched ACE, we sent it to all our investors. All we did was send an email, and we had a 2.5% conversion rate. So we added basically a $300 lifetime value to a customer and paid zero for that. That's the power of this model. And we can get a lot more refined. I mean, that's just a very fundamental, easy win. Imagine when you really start putting together looks, and Laura's team is actually creating the style profiles, and you're getting emails, or you're going to the PDP page and it shows you your look because you filled out the style quiz, and we know this is what you want to see when you go to the homepage and when you go to the PDP page. Omnichannel, Laura can talk about that too. What we've seen is we've had unbelievable success in our pop-up stores. They're great customers. So how do we step back, build that experience that really fits our brand? And just for what it's worth, we've been approached by really large mall operators at unbelievable values and deals to come in and do their stores because we are driving foot traffic. Same thing with Nordstrom's and Stitch Fix. So when you think about the potential distribution platforms, and Laura can speak more to this, they're really large. And these we might not make as much money in, but the brand awareness we create, and they're all short term, so they're not long-term channels. They're basically marketing channels. You go into Nordstrom's for 3 months, your brand equity is going to skyrocket because people trust Nordstrom's. If it's in Nordstrom's, then they're going to trust us. They're going to come back and buy online. So there's a lot of power in this. And this is what's really changed in DTC, is that these really expensive distribution channels like wholesale and stores have all come down because the real estate people or their apartment stores need the cool, hip brands to drive the foot traffic. And we're seeing that change, and it's only growing. I think that's why you see Warby Parker and Untuckit and all these brands that are doing $200 to $500 million basically play in all these spaces. Big data, we kind of talked about a little bit about that, but the ability to look at the customer purchase history, what they like, what they don't like, put them together to create a much more personalized and customized both email communication, but also an online experience. Like, if I go to Distilled, why am I looking at someone like a hipster? I'm not a hipster. I'm a very conservative, tailored kind of guy. So when I go to Distilled, I should see a Distilled look that fits that. And that's all possible. It's just the assets. It's owning a photo studio, and it's doing assets all the time. That's where we're going. And no one's doing that well. That's the opportunity. On the supply chain, when you think about the operating cost, then, like one of the brands we're looking at that does about $15 million in net revenue, they decided to do their own distribution. So it's really expensive. If we move them into our 3PL, we would save $1 to $2 million a year just by moving them into our DC. That's before you get to the fact that there's now 2 CFOs, 2 CMOs, all the same people. You got another $1 million in just basically overhead. And that's really powerful. And then you've got the tech. We're both running and paying to run 2 tech platforms. Now it's on 1 tech platform. That's what gets really interesting here. So you get both top line and bottom line. So this is kind of what we think it's going to look like in terms of an acquisition. So we'll kind of start with the left, which is acquisition criteria. I think there are a couple of things that are really important here. Number one is the brand really needs to have developed some kind of emotional connection with their customers, even if it's really small, but they're high and really big time advocates. Because if it's more of a commodity and they've grown because it's a great value, the problem is we know how that ends. It's always a value game. And someone like Zara or Walmart or Amazon, someone's going to figure out how to play in that space cheaper than we can. So it needs to really have much more of an emotional connection, and people need to love the brand and be emotionally connected to it, not for price. Also, they need to have really strong marketing economics. If they're already upside down on marketing economics, it's probably not a good acquisition, because the way we look at it is acquisition costs are only going to go up. They're not going to go down. So if they're not right-sized on that, then that's an issue. Also, box level economics. And what I mean by that is, what's the cost to get the customer a box and for them to return it? If they've got really low margins there, that's an issue, because it's going to be really hard to get that company to cash flow positive. So those are the things that we look at. And then we look at the opportunity. Like, is it a good market opportunity? Does it fit well into our closet share mentality? Is there cross-marketing opportunity? If, let's say, for instance, we have all the same customers, that's probably not a great acquisition, because you want to build a brand or buy a brand that you're going to have also a new customer, so you can cross market to both brands. So those are all the different things we look at. And then we really got to feel like they can do $50 to $100 million without much stretch. And most importantly, they need to be profitable, or after our cost savings within 12 months need to be profitable. We don't need to be adding negative brands. And I think one more thing before we go on is that when you look at this brand acquisition, you look at acquisition 1 through 6, what you'll see is we already know these are possible. We've had these discussions. We can acquire 20 to 30 companies right now. I mean, it's unbelievable. So even let's just say that we're wrong by 50%. And in 2023, we're only 150 million. You're talking about in 4 years, a company that's doing 150 million, and we're wrong, we're off by 50%, versus a company that'll do 17.5 to 20 million this year. That's a massive opportunity, and it's all very achievable. And we know these brands want to sell. So one of the things too that's important, and this is why we're going public, and I think this is really critical, we're already SEC reporting. So to go public, it's going to change nothing. The cost structure doesn't change. So we might as well do it. Number two is it's liquidity for investors. We know people want to get liquid. I mean, I'm an investor in J. Hilburn, and yet I haven't been liquid for 11 years. That's incredibly frustrating. So let's get the ability for the customer to hold the stock or sell the stock. It's up to them. But if we're performing, they're going to hold the stock, and more investors are going to come in. It's a liquidity for brands. Brands are not going to sell for private stock. They don't have an interest in that because it doesn't solve their issue. Their issue is they want liquidity. They don't want it all. They actually believe in the model. They just need, $500,000 or $1 million. So if they get that liquid stock, they can take their pressure out of their life. They're having kids. They want to buy a house. They just want to upsize their life because they've been living as a founder, which is really tough. So this gives them that liquidity. But more importantly, this liquidity allows us to buy them at a super cheap valuation, because it's like, okay, if you want 3X, that's great. You can keep waiting for that white knight to arrive. We know it's not coming. Now, if you really want to talk, we're here and we're happy to do it. And by the way, you're going to get all your money back and more, because we're going to grow this massive company. And they all are starting to understand that. And what's interesting is there are several brands that 6 months to a year ago were like, nope, we're only going to sell at 3X. We're only going to sell for cash. I'm getting emails and they're coming back and saying, you know what? You were right. I was wrong. Let's talk. I'm willing to play to your terms, because guess what? Reality is reality and gravity is gravity, and it's sucking them down and right into our vortex, which is great. And then I think what's really important too is access to institutional money. Like, this is the world I came out of, was basically public stocks. And there's no growth public stocks. There are very few. So all these institutional investors are looking for growth. And that's why we need to trade up to the NASDAQ as soon as possible, which is the goal is the first half of next year. Because when we do that, you're going to start to bring in that institutional money, and they're coming in at millions at a time. And that's really going to drive the share price up. And they're going to have to do it because they need growth. So this is just really a quick example of Victoria Carpets. This is a company that went out on the AIM at a very low market cap, 20 million pounds, which is about 15 million US. And they built their way through acquisition to basically almost $1 billion pound market cap company. So it shows how powerful this model is and why it works. Go to the next slide. So our brands. So as y'all know, Distilled is our main brand. It's been our workhorse brand, and you can kind of get an example. This is a home shot image. If you keep going to the next slide. This is a little bit about Ace. Ace is our other brand. We just launched it in March. And so this is our tailored clothing brand. We're going to continue to grow it. I think the opportunity here is, look how it only cost us $25K to launch this, because we already had the marketing team. We already had the tech team. We already had the supply chain team. So all we had to do was basically do some marketing work to figure out what brand we wanted to create, and do some photo shoots. That's the power of this model, is we can build and buy very inexpensively. This brand would have cost several $1 million to launch on its own, whereas we can do it for literally $25K, and with inventory basically about $150K. That's pretty amazing. And so that's the power of this brand, and that's the power of the model. So you've got Distilled and Ace. And now I'm going to turn it over to Laura for the metrics. Oh, there you go.
Hi, I'm going to quickly go into the metrics, but I thought what adds a really nice human component is the reason why I joined the organization. I hail from New York. I've been there for almost close to 20 years. Now I'm here in LA. I held strategic positions, head of North America marketing PR at Coach, which is a Tapestry-owned company, as Hil mentioned. There's Coach, Stuart Weitzman, and Kate Spade. Before that, I was at Harry Winston for 5 years, which is now owned by the Swatch Group, which has a total of 21 brands. And prior to that, I was at Ralph Lauren. So I have a plethora of corporate experience and definitely know how to run a very scalable model, which is what we're going to do going forward. And these are the key KPIs that I saw, which were a lot of the driving reasons why I joined the organization. You know, AOV, average order value, year over year has increased substantially, which is really, really great. It's a key performance indicator, knowing that there wasn't really any sort of resistance from the existing consumer base when we raised the AOV, and when we were approaching new customers, they were buying as well. So it's a really great indicator of a healthy business. Next slide. And then as we go on to the next slide, I talk about gross margin. Again, what really, you know, enticed me about joining this organization was the fact that we own end-to-end from the actual factory to the point of distribution, which gives us those extra points in gross margin, which we believe this year we'll be able to go to 65%. Repeat customers. As Hil mentioned earlier, there's a lot of power that can be derived out of repeat customers. They're already fully engaged with your brand. They want to hear from you. They are very, very loyal, and we want to derive off that loyalty. And what are we going to do when we have multiple brands? We'll be able to have large loyalty programs, and we'll be able to drive more and more frequency and cadence of purchase. New customers. There's definitely going to be new customers. Just in a couple of months alone, we've driven 45% increases in terms of the amount of revenue by just opening up the top of the funnel and reaching out to new, highly engaged customer bases that can drive a lot of demand. Key metrics. I just want to go into like just some really top line macro points here. This is again really about top of the funnel. Content is king. As we all know, I mean, we live in a content-driven society. The amount of content that we actually consume is voracious. A person on the daily basis actually scrolls through as much content from the top of the Statue of Liberty all the way to the ground. And I'm giving that quote because I'm a New Yorker. That's a lot of content, right? So content is king. And then not only that, when you want to go from top of the funnel, you also want to engage people in multiple points of their journey. It's all about the customer journey. You just don't want to be approaching them from one, like just Facebook or Instagram or Pinterest, one avenue. You want to look at it from not only that, from a digital standpoint, SMS, the actual hardware, the actual mobile device. Then you want to make sure that you're approaching them on those different points of the journey where it's meaningful for them, right? You want to make sure that they're open to the message that you're sending them, and that will increase the response. And curation. The person today has a much, much better editorial eye given the amount of content that we're seeing, right? So you want to curate your approach, as Hil spoke to earlier, especially personalize it. And when we have those opportunities, we increase click-through, engagement, and decrease bounce rates. And then it's all about engagement. I mean, nowadays, it's not just like, I'm so great, I'm a brand, I'm Gucci, I'm Prada, like, I'm the lion, here we roar. No, it's more about how are you engaging with the consumer? What's the conversation that you're having? We've had substantial growth in what we're doing on organic, because really in those stories, what we're doing is we're opening that curtain and we're letting you in to see our personality. Testing quotes, testing different things that have to do with people's lifestyles that don't necessarily have to do with the product, but yet are things that our customer base share and value that drives that type of engagement. Click-through. Click-through is really important. I'm militant about that with my team, that's another KPI, key performance indicator, that we need to look at and strategically understand from every point end to end that there is an incredible amount of engagement. Because if there's places where people are dropping off, then you need to focus your efforts there. Then your advertising is not working, your curated content isn't speaking to that person, and you need to flip. What's really great about digital is you're able to test and learn and test and learn. And I love testing and learning because that's how you get better. Increases in editorial on-site time, which is really great. What I've done since I joined the brand, especially being a woman, is opening up what was, you know, kind of more of a dark and a male focus, just so we can broaden it and we can speak to more women. Women are going to increase the number of pieces that they purchase, they shop more frequently, and we just want to equal out the points of distribution and how we're speaking to everyone as a brand. So a lot of the stuff that we did most recently with Terry had more of a white look. Didn't go away from who Distilled is, because we don't want to do that, because I'm speaking specifically about that brand right now. We just wanted to open up that aperture and that lens and let a different type of consumer come in. Bounce rates. Sure, as you all know, when you go on site, you're driving traffic and you get people and you're clicking off. When I first joined, we had really high bounce rates. The bounce rates were like above 45%. I mean, nothing should be that high unless you're asking someone to customize a bag 16 times to Sunday, right? So we looked at our bounce rates and how we could enhance that experience online to decrease them and increase the consumer's time on site. These are just some amazing different types of imagery coming from our organic, as I spoke to earlier, looking at those quotes, things that kind of resonate and speak to the distilled brand, but don't necessarily say you have to buy a product at this moment, right? It's just resonating with the customer and hitting them with relevant messaging. Another image from one of our Instagram ambassadors as well, Mika, Catch Me If You Can. Beautiful image. That was during a time when we were celebrating Black is the New Black, and we were using the algorithm to increase the amount of relevancy and likes we got on her image. And then the last shot is from the Terry campaign when I was talking about opening up that aperture and making it more female relevant. I mean, it's a couple in love, and we were able to actually promote sales for both genders. Again, another reason why I joined the brand is that there was a lot of really, really amazing, great traction, especially from the celebrity component. And I'm coming from a brand where it was basically pay to play. I mean, it was written in the news, so I feel totally fine sharing. We paid Selena Gomez $10 million to endorse our brand. Charlize Theron, Bella Hadid, Jennifer Lopez, all of these celebrities are endorsing Distilled without any sort of payment. So that's really, really great organic engagement. These are some other celebrity shots as well. And then press. I mean, we've really gotten, we're called like the Everlane of leather jackets. We've gotten endorsements from Vogue, Esquire, GQ, and they just continue to grow. We just got something today from Refinery 29. Again, we're doing a lot of this even just on our own, which is really great.
All right. So given that, I think it's really powerful what you've been able to do. And most importantly, I think it really shows where we can take this. I think we have process, we have strategy, and now we're just getting into data. So what we've been able to do is do all of this without doing a deep dive into data. And I think that's really powerful. So why does direct to consumer matter? So direct consumer matters because you can own value. You can sell the same product quality at half the price as Nordstrom's or Neiman's. And that's really critical. And that's why we moved our supply chain to Europe, because we needed to be using the same mills and the same factories as Mother, as Frame, as J Brand, as AG, as Diesel. And that's the same thing we're doing with Ace. We're out of the same Italian mills, Guabello and Marlene and Laura Piana. And that's really critical. We're making in the same factories. So if you own value, but you go direct to consumer, you don't have the wholesale markup. And if you own value, customers will buy you because customers are smart and they know. That's why Amazon and Zara and Walmart and all those brands are so powerful and so big because customers go value first. Data driven, we're just starting this whole process. But imagine the power of owning that data. Like at Coach, she had none of the data from her department store sales. So imagine she's blind for 80% of her revenue. She doesn't know where it's coming from. She doesn't know how to thank you for the customer. Perfect example is we can make our own pocket squares at Ace, and we can basically customize them. We can do a color on the outside. We can put their initials or whatever we want in them. Cost us very little money, $3.50, and we can send those to our best customers as a thank you during the holidays. And for the customer, they feel like they're getting an amazing, thoughtful, customized gift. And for us, it's very little. Coach could never implement that. None of these brands could ever implement that because they don't know who their best customers are because they're at the department store level and they're not getting that data. This is really powerful. And then the seamless experience. This is a big thing, is we can basically follow you. So if a customer walks into the store, we know who they are, we know what they bought, we know what they've looked at online, and vice versa. If they've been to a store and then they're looking online, we can literally know what they're interested in. So this seamless experience where we can really create and complete the customer's journey wherever they are is so powerful. And it's because it's the same back end, it's the same technology, where the stores and the online, or a wholesale brand and their online, it's two different technologies and they don't talk to each other. And so they can't pipe data from one to the other. So it's a very disjointed customer experience. We don't have that issue. And that's going to be the future, is how do you take a seamless customer experience and use physical and traditional and digital advertising to acquire the customer, but then you own their entire experience. If you go to the next slide, this is a perfect example of how we drive value. You'll see that $85, that is exactly what J Brand or AG or Mother and Frame would sell their product to Nordstrom's or Neiman's, and then Nordstrom's and Neiman's marks it up to make their margin. So all we are is our retail price is in essence our wholesale price or someone's wholesale price. And that's why the power comes in. And in fact, the more expensive the garment is at retail, the bigger price value we create. So an example, like let's take cashmere, something like that might have a $200 a wholesale price. So then they're selling it for $450 to $500, and we're selling it for $125 or $150. So the higher cost at retail, the better value proposition we have, because the markups basically go up exponential instead of arithmetic. This is Laura, I'll let you talk about this.
Yes, this is our slide where I'm basically saying what's really great, and again, the reason why I joined this organization is it's really the marketing strategy drives it versus the brands. You know, I came from Tapestry Organization, Swatch Group prior to that. It would be every brand for himself here or herself. Here you really see that the strategy is driving the brands that are getting all of the data that we're then using with the partners across multiple channels and driving engagement. And what it also enables us to do is to have this circle so it's more sustainable, because we have multiple brands, data points, and touch points all working together.
Experience. We talked about the seamless experience, which I think is really powerful. You got me? Okay. So we talked about the seamless experience that's really powerful across these different online showrooms and third party. And I think that's really the powers. We can use all these channels as we need. And the way we kind of think about it is, how do you use these different marketing, whether it's pop-ups, whether it's a third party with like a Stitch Fix or a Nordstrom's or a Barney's or a Bloomingdale's, to basically acquire the customer in a very trusted, elevated channel, and then use our online as our retention engine and continue to drive retention and loyalty. That's how you got to think about it. So in all these things, like the showrooms or the third parties, they're all going to be short term. You don't want to create these long-term liabilities, and you also don't want to create a change in your margin structure. So we don't want to become a wholesale brand where we're selling it at that. Now, if Nordstrom's came in and said, let's do a private collection and do it more at a wholesale level, we could do something like Nordstrom's by Distilled or something like that, but that's a whole different product category, and it would give us halo. But for our core brand, we don't need to go to a wholesale model. But Nordstrom's now, 50% of their revenue comes from direct-to-consumer brands that are coming in for 3 to 4 months at a time, because it's driving foot traffic. And that's the same thing that's going on with malls. We're talking to two of the largest mall operators in the world, Westfield and Mason Ridge, and they're talking about doing a whole store development that can be anywhere from 3 months to 3 years on a lease, and then they'd pay for the FF&E, and the rent is really low. We need to leverage into that, but we need to figure out what our store experience needs to be first. So there's a lot of power there. I'm going to go into management, sources, uses, etc. And then I think on the management side, you've seen Laura, you've seen Hil. Paul Ruffy is our design director. Y'all may or may not know him from the past, but he's there. And then we're also going to be adding a CFO and a CEO. And then I think this one said, yep, so here's our Reg A terms. So you can see we're going to have it open for 45 to 60 days. It'll be preferred, which is anti-dilution in a down round. The share price, the minimum investment, the perks is the major thing here. This is driving a ton of investments, and we're really excited to see that. This is something, like I said, for the $500. We really appreciate everyone reaching out and letting us know their pain points, and it is something we'll definitely consider. And I think on the $35 million valuation, I just really want to stress this because I think it's important, is that through an acquisition, we are basically going to we've already grown into our valuation. So was it a little rich before an acquisition? For sure. But with an acquisition now, and then especially with an acquisition next year, it's an unbelievable value. And I think that's the big difference. If this was just Distilled and Ace, this is not an interesting investment opportunity. If it's Distilled, Ace, in an acquisition model, this becomes an unbelievable, powerful shareholder equity model, because you're going to drive meaningful growth, and it's low risk because you're buying a company that's been built, and all you have to do is basically just take better care of it, as opposed to how do we get distilled to $250 million in revenue. That's a much harder challenge than how do we get to distilled to 50 million, ACE to 50 million, and these two brands that we're buying that are already doing 5 to 15 million to 15 million.
All right, thanks, Hil. From here, I'm going to bring it into Q&A. As a reminder, for those of you that have any questions, please click the Q&A icon on the top or bottom bar of your screen, and we'll line them up in the queue for Laura and Hil. Hil, the first question goes to you. Last semester you were talking about the AIM market. Now you're talking about the OTC. What has changed, and why do you think the OTC is now a better place for the group to be?
Well, so it's a great question, and it's something that we actually went over to London and met with investors and met with the London Stock Exchange. So it's unfortunate because AIM is actually the better market, to be honest. The issue is the tradability of the shares for U.S. investors. It is very, very onerous. And while it's getting better, it's not going to get better soon enough to make it work. And so while we would much prefer to trade on the AIM market, we think that's the better market, it's going to punish our US investors, and we're just not ready to make that step right now. So that's the biggest issue. And let me be more specific. The way the shares are held, and by the groups that hold them, whether it's the brokers, the dealers, and or the actual digital holders that keep it of record, they're not the same systems in Europe as they are in the US. So there's no way for them easily to talk to each other. So the cost to trade shares is going to be really high for a US investor because they have to engage a higher cost broker, and then the cost to actually digitally transfer the shares becomes very expensive. There's some lockups that could potentially happen 6 months to a year. So it became a little bit more of a bigger, daunting exercise for our US investors that we just thought would actually punish them, and we didn't want to make that. That's why.
Great. And while we're on the topic of listing, can you please go through a timeline of what that might look like?
Yeah, absolutely. It's a great question. So what happens is when you file the 211, and we've already brought Glendale Securities on to do our 211, you cannot issue any new stock per FINRA because they're going to do a review of the cap table, make sure it's clean, it's pristine, and it's okay to trade. So the thought is we keep this Reg A open from 45 to 60 days. So basically mid-June into June. Then we file for the 211. And the reason we're going to do 45 to 60 days is that's how long it's going to take us to put together our whole 211 application. So during that time, we're putting that together. The second it's ready, we'll go dark on the Reg A. We'll shut it off and then file the 211 so FINRA can start reviewing our application. FINRA will take anywhere from 2 to 3 months. And then during the same time, we've applied to the OTC. We've already talked to the OTC. They're all good. They know us really well. We spend a lot of time with them. So that both of these are more of just a check the box process. The OTC will take about 4 to 6 weeks to approve us. FINRA will take about 2 to 3 months. So now you're looking kind of basically end of August at the earliest, end of September at the latest, that we are trading on the OTC. We've been approved and we're listing on the OTC. So that is the basic timeline. And the reason we might be earlier is because we're already PCAOB audited. We're already SEC reporting. All our shares are held by V stock, whether you invested in Seed Invest, whether you are a seed investor way back in the day, whether you buy in this Seed Invest round and the Start Engine round, it doesn't matter. All of it's held by one entity, V stock. So the nice thing is it's all one central location, whereas a lot of these companies that apply for the 211, it's a little bit of a mess. Like, oh, I got to go find the email that shows they own these shares. Here it's all streamlined. So they think it could go faster because of that. So that's what the timeline looks like.
I thought the next question is, I thought the OTC had mostly penny stocks. Can you please explain more about the OTC and if you have an opportunity to uplist to the NASDAQ?
Yes. So the OTC actually has 3 different markets. They've got the pink sheets, which is the penny stock, which is predominantly what they're known for, no doubt about it. Then they've got the QB market, and then they've got the QX market. Their QX market is their highest quote unquote quality market, but it requires quarterly reporting. Their QB market, they actually created for Reg A companies. So it follows the exact Reg A reporting timelines because the OTC wants to be the home of Regulation A+ companies. So if you look at the SEC reporting requirements for a Reg A company and the reporting requirements for the QB, they're perfectly aligned because that's how they built the market. So the first step is to list on the QB. And then once we have a $5 million in shareholders' equity, we'll uplist to the NASDAQ. And that will hopefully be the first half of next year. So that's the only reason we're not going out on the NASDAQ. And then once we go to the NASDAQ, though, we will have to do quarterly reporting versus semi-annual, which will add about $30,000 to $45,000 in expense to our OpEx. And real quick, the OTC QB market is actually an okay market. The question is there liquidity? And we have over 4,000 consumer investors. So the biggest issue has always been liquidity, that most OTC companies are owned 80% by the insiders and they're not selling. So the stock doesn't trade. For us, we won't have that issue. We will have meaningful liquidity. So we take some of the risk off of that. And then secondly, to be quite honest, like when you look at a lot of the OTC companies, they're much more high risk, high reward, whether they're mining companies or oil companies, or they're pharmaceutical, a lot of pharmaceutical companies. So you're making a big bet that they get approved by the FDA. One of the things that's nice here is we're going to basically keep everyone updated on our numbers. So you have a truly operating company, and that way you're really kind of staying at the high level. And I think that's a big difference too. I just think a lot of it is how the company is built and how they actually report out is going to change that. And that's why we think it works for us, especially for a less than 12-month time period.
Thanks, Hil. Laura, the next question is for you. There's a lot of exciting AI software out there that help increase sales. What are your thoughts on incorporating this into your marketing strategy?
Yeah, I think, yes, I do think that there's a lot of interesting things going on with AI, but I think at the end of the day, you can't forget the human component. I think it's great, as I said earlier, digital gives us that amazing opportunity to test and learn. So I think in the world of AI, there are definitely advances that we are currently taking a look into, and I do think that there will be places in the future where we potentially will incorporate them, but I always will couple that with the human component. I don't want to just make it digital only, then it becomes extremely transactional.
Thanks, Laura. In regards to making new brand acquisitions, how will you be structuring these?
Not cash, and then there'll be an earn-out option. So they will have to, so you're making 100% of the acquisition, 55% now, the other 45% earned out over 3 years based on hitting different metrics. So it'll be an all equity deal. Over time, that could change, but at least for now, that's going to be the structure. And at some point, it's going to be better to pay with cash or debt because the cost of the equity. But what's really important too is if you're trading at 3 times and you're buying at 1.5 times, you're arbing every single acquisition. And so if you were theoretically paying, let's say 20 million, you're really paying 10 because of the arb.
Thanks, Hil. The next question, perhaps both of you can speak upon this. What makes Distilled Ace and any of the other brands that you acquire? What gives them a competitive edge against the other brands in the market?
Well, I think you have to, I'll kind of take at it, and then Laura, you can go after that. I think the first piece is that there are 2 markets in my opinion. There's the DTC market and the wholesale market. Anytime we're talking about a competitor in wholesale, same product, half the price. That value proposition is critical. And so then it's a game of brand awareness. If the product quality is what it should be and the price is what it should be, which is same product quality, half the price, then you're always going to win against your wholesale competitor because who's going to pay twice as much? So then how do you market it? How do you get the brand awareness out there? How do you create virality? When you're going against another DTC company, it really comes down to who's going to have the better product and who's going to create the better brand. And that's what it's going to come down to. But I think one of the things that's really happened in the DTC space is while it's easy to launch a DTC brand, it's incredibly expensive and difficult to scale it. So for a DTC company code 0 to 1 million, no problem. You've got AWS, you've got Shopify Plus, you can probably get the first PO, no big deal. But all of a sudden, if you've got to go acquire customers at 85 bucks plus buy the product ahead of time to basically fulfill against that, and you've got to have a marketing team, you're going to need, the average DTC company needs $30 million. Where are you going to find that money? And that's basically what we're seeing is these companies now, they're not getting the VC investment. So they're only growing 10 to 20% now because they have to get to cash flow positive, and they don't want to grow. They don't want to be in a company that's like this. They're just tired. And so they prefer to come into a brand where they can go back into growth mode. So we actually think these DTC companies, based on our conversations, they're actually looking to find someone who's going to help them accelerate their marketing dollars because they can't afford to acquire customers because they've got to run the business cash flow break even.
Yeah, they can't afford, I'll just dovetail on what Hil said, they can't afford to continue to penetrate digitally all on their own. That's what makes this a really great proposition for them. I think that you have a partnership and a back end, and we're going out and purchasing and going to Google, going to Facebook with $500,000 that we can spread across a plethora of brands. It also lets these brands, more importantly, which is more importantly to me too, it lets these brands stay who they are and what made them so great. What happens to a lot of brands when they want to scale is they try to be one size fits all, and they try to do everything for everyone. You can't speak to everyone with the same message and think you're going to cut through. You're not, especially now where you're advertised to everywhere. What this proposition does is say, don't dilute who you are, don't lose your equity, stay who you are. You can continue to be who you are, because guess what? We're gonna buy advertising dollars against that, and you're able to actually expand your footprint in the universe. It's very unique, and again, I'll say it again, a sustainable proposition for them.
One of the things I want to, and I can see the questions as well. There's a question here that says, what caused the delay for listing on Seed Invest last year? You said Q1 2019, and then that was it. We actually went to do the deal on AIM. There was a lot of investor demand, but as we got into the weeds of trading the stock, and we'd be Reg S, which the Reg S didn't bother us as much because it just means you have to sell to a European investor, not a US investor, which is fine. But who owns it? Who's the custodian of the shares? What's the cost to trade it? Some of the things that they had told us up front about how easy it would be just wasn't holding up to what the reality was when we talked to the London Stock Exchange. So at the end of the day, it became, why is it further out? Because we're walking from AIM. Because of that reason. We can go do AIM, and listen, that's an easy decision for us. That, you know, AIM's a great market, we can grow really quickly over there, but to be quite frank, it screws y'all. So, I mean, it's an easy decision for the company, it's a bad decision for the investors. And that's what we had to spend a lot of time speaking with. We had a board meeting last week to talk about this too. So it's really about the tradability of shares. And then there's a lot of questions I see on the OTC and listing on the NASDAQ. Think of the OTC as a weigh station. And the only reason we're listing on the OTC is that these acquisitions that we're about to make, they're not going to sell for private shares, period, end of story. There's nobody who's willing to take private shares for private shares, period. So we either have to raise 20 million, which is going to dilute the stew out of everybody, or we're going to have to basically get public to get this acquisition done. So it's the acquisition that's driving the OTC listing, and then we're going to uplist to the NASDAQ as soon as possible, which we think is first half of next year, based on you have to have a 5 million shareholder equity. And so that's basically what's driving this. It's the fact that to make the acquisition, we have to be liquid or we have to pay cash.
Thanks, Hil. The next question is about Amazon. Is there any variant brand of distilled or offshoot to address the Amazon market or marketplace? Are you looking to just stay premium and keep off marketplaces?
Yeah, it's a really great question. It's something that we've actually been looking at. I think what we found, for the record, Amazon actually wants to be a part of distilled. We've met with them multiple times. We've been to their roundtables. The issue is they want us to sell on their site. And what we've seen historically is they're basically going to put us up for sale. then scrape our data because we don't get the data from them. They hold the data. They will not share it. And then they're going to start running their own brand next to ours. So if you look at some of the watch companies and other companies that have launched on Amazon, you go and you Google that brand and there's an ad right next to it for Amazon's private label. And they're doing it a ton in the beauty and the CPG space, consumer packaged goods. And so basically our concern and most direct consumers' concerns are the fact that Amazon's just going to use our data to launch their own brand. And so it creates a real issue there. Now, one thing that is interesting on Amazon is, do we use it as a way to clear inventory? That's a potential, and it's only product that we're looking to clear as a last resort. That's something that a couple of DCC brands have had some success with. So we're watching that and we're talking to those brands. But Amazon is really powerful, but it's really damaging. Now, there is, as under the digital brand portfolio, there's an interesting opportunity to do a partnership with Amazon where we're making denim out of, say, Mexico or Asia and selling it for a lower price point that we would co-own. And basically, we bring the supply chain, they bring the marketing, and that would be a DBG company. And you think of the power of that, that gets really interesting, but we're not hurting distilled. So those are the different things we're looking at. But Amazon, you got to be really careful because they're trying to get in this space, and you don't want them to use your data to put you out of business. It's what Netflix did, right? To CBS, ABC, et cetera.
Thanks, Hil. The next question is for Laura. Laura, you talk about an audience first approach. Can you go into more detail about how this is different from other brands?
I'd love to. It's actually a platform that I stand behind vehemently. I believe that the way that consumers consume is much different than it was years prior, and the way that we're spoken to is very different as well. I think audience first, essentially going audience first is how you buy digitally. It's just not how brands usually approach their creative or their messaging. But with Digital Brands Group, we will be audience first. And what that means is putting the audience mindset, needs, emotional engagement, etc., at the top of the brief or paramount to whatever sort of execution you want to do, and then basically weaving your strategy against that. So it's thinking about where the consumer is, what they're thinking, what their appeal is, and then putting the brand messaging into their mindset, right? Because you really want to change their perception, and that's what you're going after. And you can't just be a brand and just think everyone wants to be a part of it and who cares, and whatever audience, it's aspirational. Like I keep saying, some of these historical luxury brands like Givenchy, Prada, as I mentioned earlier, was like, I'm a brand, hear me roar, and you're gonna just walk into my store. It's not that way anymore. Everyone has a million different options. That's why you really have to define who you're going after, what their trigger points are, and then creatively have your campaign go after them.
Yep, I think real quick, there's a question on here too. Why we went from Seed Invest to Start Engine. We actually talked to Seed Invest about this. We had just done 2 deals with Seed Invest over the last 12 to 15 months. So we felt like both Seed Invest and ourselves that it was just time to give it a rest. So that was why they felt like we had basically really penetrated their market group, and that it was better. And for what it's worth, just to be clear, is we had a contract with them, and we both agreed that, you know, let's create a walkaway just for now for this very reason. So it was a conversation we had with them, and it's something that we thought hard about. We just felt like we needed to reach out to a new audience, and so that's what's driving that. And also, what was nice about this is you can do a much lower offering price, whereas Seed Invest, they prefer to see a much higher average investment dollar amount. And we just kind of felt that it would be nice to lower that if we could, which we were able to do on Start Engine. And that's kind of why you see the difference between the amount in basically the 1,500, I think it was, for Seed Invest versus the 500 in Start Engine. It's the difference in how they approach the markets and what they want as thresholds. And we thought that was really compelling and interesting because it could open up our potential customer base. And by the way, what's interesting is there's a question on, the $500 credit. Doesn't that seem really high? The answer is yes and no. It's high now. So if you think about, we have a 50% contribution margin, $500 is $250 in cost to us, right? Because the rest is profit. And then when you look at the spend of an investor and what an investor / customer spends over their lifetime over 12, 18, and 24 months, they by far spend the highest amount. So believe it or not, even though it's costing us $250, we get that $250 back faster than a customer who comes into a digital channel. Because most investor customers, where are they going to spend their money? They're going to spend their money in a brand that they own shares in. So while it on the face, you're exactly right, it looks extremely high and stupid, the reality of it's actually an unbelievable ROI relative to all our other channels. And in fact, there's another company, Hiley, which also is backed by the same debt company we have, which is Black Oak. They've done a Reg A+. They've done something very similar, and their data and our data look almost exactly the same on programs like this. So it's not just us, we're seeing it in other brands as well. So it's actually a very clever marketing approach, because the way we look at it is you're rewarding our investors / customers. And when you look at our fall product coming up, we're going to have unbelievable cashmere, outerwear, leather. It's going to be our best offering ever. I mean, it's sick. It's awesome. And so when you look at that, the fact that we know they're going to spend the $500 now, why not try to take investors and turn them into customers, because we know their spend is so high. So it's a very strategic point of view.
Thanks, Hil. Can you talk about what your plans are to acquire and retain the right talent in order to bring this group to where it needs to be?
Yeah, it's a great question. And as perfect example of that is why we got Laura. I mean, we really had an unbelievable choice of CMOs, and we actually, the CFOs and COOs that we're looking at, they're coming from multi-billion-dollar, in tens of billions, market cap companies. And the reason is because they understand what's going on in the wholesale world, and they understand what's about to happen and is happening in the DTC world. And if we were just Distilled or Ace, not going to join us, not of interest. It's just not worth it. But this roll-up strategy is what really gets them excited. And that's what's doing it. It's the fact that it's this bigger vision, and the fact that we'll be publicly listed. If we were going to stay private, had a bunch of venture capital money behind us, they're not interested, because they've seen what happens. They have no control over their liquidity. They have no control over the vision of the company, because the VC will decide what they want to do, and they don't understand consumer most of the time. There's only 1 or 2 VCs that I've ever met that really understand consumer. And Jeremy at Lightspeed's really great. The Andreessen Horowitz team's really great. I mean, we had Battery as an investor. I would not take money from them again. It wasn't. So we've seen this experience, right? And I mean, they're great people, don't get me wrong, but as far as like understanding the brand, it's just in consumer, you got to find people that really understand it. And so for the people that are looking to join us, they want to know that they're not going to be walking into a board full of VCs that just don't understand consumer, and that there's a real outsized opportunity here. And that's what's getting people to come. And it's more expensive to bring on people like this, but your return on them is so much faster, because they can really drive meaningful growth.
I could just say from a marketing perspective very quickly, is just driving from my own experience as a coach, and the way the consumer, why I'm audience driven and how consumer habits were changing. I mean, my marketing budget was basically used as a gap to make sure that the dam wouldn't overflow, right? I mean, I was making sure that outlet business was still moving, wholesale, multiple partners. It basically was being used as a Band-Aid rather than trying to build a brand or brands. And that's what this proposition is about. And that's why it's so alluring. You're using your marketing budget to really expand a footprint and to really change someone's perception versus rather than just trying to fix something that's about to explode.
Thanks, guys. Perhaps you can both speak a little bit more on this next question regarding pop-ups. I know you briefly went into it in the presentation, but what are your long-term pop-up and or store plans?
I'll give you, I'll start with what I think is the overall strategic view that you and I believe in, and then I'd like you to kind of go more into the details of how you think about it and execution. So I think basically based on the data that we've seen from the pop-ups that we've had, which are 3 in LA and 1 in New York, that customer spends more over their lifetime. They spend more a lot faster. They have lower returns. So when you look at it from a LTV and a margin basis, they're much better customers. We also saw this at J. Hilburn. Our average customer in J. Hilburn in stores spent $1,000 versus $350 with the stylist. So we know they're really powerful. We know they're great for acquisition, customer acquisition, and creating that emotional connection and that brand loyalty. And then we also are looking at them as they've got to be very lightweight. And what I mean by that is they cannot be long-term leases. They can't sit on the balance sheet. We have to be very nimble, and they have to be very specific and optimized for the right markets. And like as an example, Charlotte is one of our top 5 markets. Why or how, I have no idea. I would think Nashville is much more of a denim market than Charlotte. So we should probably test a pop-up there and see what. And then we should also test one in Nashville and just see if it's a brand awareness. So it's really a great way to look at our data and say, this is what we think should be happening. This is what's happening. Why? Let's use a physical model like a pop-up to go in and see if we can take someone like Charlotte and take it on fire. That's already a great market, and something like Nashville, which isn't even in our top 20, and turn it into a Charlotte. That's what we really need. That's how we're looking at it. But I think that's a really high level answer. But I think when you get down to the execution and the brand and the execution, I think Laura really needs to talk about that because it is critical.
Execution is critical. Execution is critical in everything that people do. I mean, what I would also say in terms of the pop-up and going back to being audience driven, you go into these markets and you're able to have that brick and mortar, that emotional engagement, that human touch experience during a time that's relevant, right? You don't have to have a store space that's fixed and you're there all of the time. You're actually able to be more nimble and more agile. Another reason why I joined this organization is the ability to be nimble and agile, and having these pop-ups during different times in different markets, as Hil said, in Charlotte, maybe it's in Nashville. You know, not everything has to happen in certain paramount places. It can also happen in ancillary markets as well. And it gives us a really good chance to actually have that one-on-one engagement with the customer, which is so important, because we can't forget about what we're doing. It's about the customer. It's about being audience-driven and customer first. That's why these opportunities are so great. I mean, what Hil and I both feel very bullish about is you just can't go into one channel and one channel solely. You can't just be in digital and expect it's going to be ride or die and you're going to win the game that way. You're not. You're actually going to blow through all of your cash. You need to meet for your channels and meet these customers at relevant touch points in different pieces of the journey in order to get that higher LTV from them, right? And you're going to do that at scale, and that's what we're looking to do. And in terms of the execution, and to be more tactical in what I'm talking about, is that this fall, what we're looking at is potentially coming up into some markets, going into a larger market like New York, but then after that, going into other ancillary markets to ensure that we're going to have scale. We're going into multiple markets, and we're able to have those one-on-one relationships and really hear from the customer. And again, if there are things, feedback, changes we need to make, because we're a nimble and agile organization, we can do that. When you're part of a coach or you're part of like a larger group, it's usually I know it because I lived it. If you want to do something that a customer really likes, it's white jeans, it's some sort of customization component, your lead time for that is a good 9 months, right? So we're able to actually go get live feedback and make adjustments where we see fit, if appropriate, if there's enough consumers that are reacting to it favorably.
Thanks, Laura. All right, I'm going to end this with one last question, but as a reminder, if we did not get to your question, we will follow up via email.
Well, hold on, Hannah. I think I can, let me just, I think some of these are technical. Can I just blow through a couple real quick that I'm looking at?
Yeah,
so,
sure.
Number one is, where can I see the audited results? Which company is the custodian of shares? VStock is the custodian. We just filed our K1, so just type in distilled K1. It's filed with the SEC, or you can go to the SEC website and look there. Number two is they ask about the NASDAQ minimum price we listed for, with some conditional possibility of 2 to 3 closing under certain conditions. The way it's that, don't think stock price and valuation are two completely very different things. Stock price, you can manipulate stock price. Like for instance, For the OTC, we're going to have a $5 stock price. We're just going to do a reverse share split. So basically, we'll take our shares from approximately 70 million and basically do like a 7-for-1. So we have 10 million shares, but now the stock price is 7 times 53 or whatever it may be. So basically, the stock price you can manipulate in terms of the share count however you want. And so the market cap's very different. The market cap threshold's not an issue, and the stock price is not an issue because you can just reverse the shares. And actually having a smaller share base is better because it actually takes less earnings to move the less cash to move the earnings a penny. So for instance, if you look at someone like LinkedIn, one of the reasons they traded so high so fast is they had a very low share count. So when they reported earnings, it only took like, let's call it $1 million to add a penny, where if you take someone like Microsoft, it takes $100 million in earnings to move a penny, right? That's a big difference. And also it increases the spread in the bid ask, because if you only have 10 million and 50% is trading, the bid ask is going to get higher, which means the price is going to be going a lot faster. If you have a ton of shares out there, the bid ask is going to be lower because there's a heck of a lot more liquidity. So don't focus on the stock price. The stock price is irrelevant. We'll basically reverse our way into the stock price that needs to be required, which happens all the time. And so that's not really an issue there at all. And the valuation is not an issue. It's the 5 million in shareholder equity. It's the shareholder equity that you got to look at, which is on the balance sheet. It's at the bottom of the liability section of the balance sheet. We need 5 million in shareholder equity, and that's going to be done through profitability and capital raises. How has ACE been doing? Have sales begun? Yes, we've had great traction. We've had about 2.5% conversion rate. The goals for 2019 for ACE are, our goal is just to learn about the brand and build it. So don't think we don't have, like in our model, we don't have a massive number. So our goal is just to basically just continue to develop it and figure out what products go into it. But we've been very happy, and it's in line with our expectations of how many distilled customers would become ACE customers. And we're actually talking to Macy's there about going into a handful of Macy's stores into their pop-up section, which I think would really make a big difference in terms of the awareness and the growth of ACE. NASDAQ minimum price, we talked about that. It's we'll reverse our way into that. That's not a problem. The equity threshold for NASDAQ's 5 million. How do we become a higher value stock on OTC? We execute. That's it. It's simple. And it doesn't matter if it's OTC, AIM, or NASDAQ. You don't execute, your stock price doesn't go up. You execute, your stock price goes up. We have to execute. And we execute by bringing in people like Laura. That's how you execute. You bring in great people and you basically incentivize them and the teams with them to grow the brand, and you take your time and think strategically, and you process. Alabama, where I'm from, I'm a huge Alabama fan, has the #1 football team and is always in the playoffs because Nick Saban drives process. We never had process. The first thing I did as CEO was start to build process. Built it in supply chain. We're building it in ops and finance. Laura's building it into marketing. Process drives strategy. Strategy drives results. Data, and then you look at the data and you basically apply the data to the process, and you're back in the loop. Process. That's what we're going to do, and we're going to own that. With regards to making acquisitions, taking out loans, investor money, it'll actually be the stock like we talked about. In terms of dilution, what does it look like? It's really going to depend on the size of the company we buy. The dilution is actually not as relevant relative to the value that we created. It's going to be publicly traded. So dilution is not an issue. The question is your share price. If we're making an acquisition and your share price is going up at a higher value than our actually cost to acquire, that's all that matters. And so don't get caught in dilution. Once you're publicly traded, dilution is not, it's irrelevant. It's about your share price. And if we're making acquisitions at 1.5 times, but we're trading at 3 times, we're driving a ton of value. So think about it as, are we driving the share price up? Not about dilution. That's what it's about. Yes, a public listing on the U.S. market for sure is, we're definitely going down that path. We're filing for the 211. And then there's one more question real quick on our Q1 increase. And basically we've been promotional in the last half, or in the first half of this year versus last year. And that was intentional. One of the things we were looking at is our customer cohort data and our retention. And we actually, when we did the sell, we actually broke it down and sent different groups, different emails. This is what Laura did. And we're tracking cohorts to figure out what cohorts would engage and if we could revive some customers that have gone away in older cohorts. So this is actually more of a way to basically what we call win back and bring customers that haven't bought in a while back into it, or see if it would bring them back into it. And then from there, what can we learn from them? What's their repeat rate? Do they repeat every 90 days? One of the things we're looking at as an example is if a customer doesn't repeat, why? What was it, a product they bought, or is there a certain time frame? Like if we drive a repeat within 90 days, like if our most loyal customers, they all had a first repeat in 90 days, and then if you don't drive a repeat 90 days, they go away. How do we as a company create a very personalized communication email strategy at 30, 45, 60, 75, and 90 days to make sure we drive a transaction to 90 days to keep stickiness? That's the data in the process we're talking about. No one's ever done that here before. That's what we're doing. So the sale was a way to figure out how we could win people back, what people were buying. Now that they have 30% off, are they buying leather? Are they buying denim? Believe it or not, they were buying all our higher end products, which shows that people really have that desire to own those products and they believe in it. And so we really wanted to test a bunch of learnings. So before we did the sale, we said, here are the things we want to learn by customer type, by product type, by customer mentality. And now we're scraping all that data to really figure out, like we have some customers that will only buy on sale. That's what we're learning. They're only going to buy on sale. So we have to think about, are those customers we really want to keep? Like, are those the right, we don't want to build the brand around them because we're always going to have to mark up to mark down. So how do we think about that? How big of a percentage of our customer base is that? Those are the reasons for all that. So Hannah, I'm sorry, I just wanted to make sure we got to those answers. I thought they were very fair questions. So what's the question you wanted to add to that?
No problem. That was our quick fire round right there. So just the last question is, Ryan is asking, looks like Digital Brands Group has not filed notice in the state of Delaware. Will you be doing so? Can you please let us know if you'll be getting broker dealers in the other 10 states?
Yes. Oh, so yeah. So specifically, you're talking about the broker dealer for the Reg A Plus. Yes, we're actually working with Jumpstart right now. They're doing their due diligence. And Hannah, I don't know if we have a timeline on when they think they'll have completed the due diligence and approved us. Do you know?
Yeah, it's about 2 weeks.
Okay, so we're 2 weeks out from those from Jumpstart being able to open up all the states that require a broker dealer to trade in. So this was something we knew that was going to happen. We decided, given that we have such a short window before we filed the 211, to go ahead and open up the Reg A and basically open up the Reg A and onboard a broker dealer at the same time, run them side by side. So we've been working with Jumpstart from day one, and they are going through the process. As an example, one of the things we've learned through Glendale Securities' 211 is you can't, if you have shares that are been owned by a credit card, those shares cannot be allowed because there's no clear path of ownership. So with Jumpstart, we made sure, for instance, and with that they can't take credit. You can take debit cards, but you can't take credit cards. So those are all the things we just had to make sure we had aligned up. And Seed Invest, we did the same thing. So in 2 weeks, all those states will open up for everybody. And by the way, I do think they can still make, so they don't lose the credit, can't they still make their allocation, Hannah? And then when it opens up, they'll get the credit. Is that correct?
Yep, that's correct. So as long as you commit your investment by the end of this weekend, we'll be honoring the $500 credit. And once your shares close, we'll be issuing it.
Great question.
All right, thank you everyone for joining us today. You asked a lot of great questions. As a reminder, we will be offering the $500 store credit through the end of the weekend. And if you have any questions, please email us at invest@dstld.la, and be sure to check out our Start Engine profile at startengine.com/DBG. Thanks everyone.